Good morning, ladies and gentlemen, and welcome to the show on this Friday, the 13th of August 2021. Thank you for tuning in. Guess what? Uh, the big story today is China. Do you remember when the virus first came through China? They took drastic measures and they were able to stop it. And so China continued basically with the big open sign on. We're open for business. While the West, we had a lot of problems over here in the West, And one of the things that drove lumber prices up was all these lockdowns and stuff, we had. Well, now it's striking back over in China. Let's get started. Let's open the charts up right here. Take a look at what's going on. Big container terminal over in China right now. The shippers are frantic after China's busiest port, the busiest port of all of China, shuts container terminal due to COVID. Container shipping, this is where all of our products come from over here. Almost everything that we, maybe not so much food, but everything you buy, like if you go to Amazon or whatever, most of the stuff comes across on a container ship from China. And so what does this mean if there's a, well, it's tremendous, the amount of goods. Do you remember when that container ship got stuck cross sideways in the canal there a few months back? Remember how it blocked up container shipments? It says reports and logistics operators, all operations at the Ningbo Mindong container terminal, also referred to as the Mishan terminal, were immediately suspended following a positive test results. With this sudden suspension, we expect a delay in planned sailings that might affect your cargo planning. Please know that we are working on alternatives and hope that you're understanding a matter that is beyond our control. German vessel operator said to a customer notice posted on his website, anticipating the howls of rage that is already stratospheric shipping rates are poised to surge. There are 5 container terminals at Ningbo. The port's decision to shut down vessels and gate operations for at least a day, effective estimated 20% of the port's capacity. So I see this just as the beginning of something really big here. They're shutting down ports and container terminals due to this outbreak. What kind of success will China have at stopping this variant? Well, it's far more contagious than the original. And so this could affect prices. This could affect, not right away, but see, it takes time. They load up containers and stuff. It takes time for them to sail across the Atlantic, sail across the Pacific. It takes time. And so when you get something like this, a shutdown or a lockdown on shipping, then that translates to a couple months out before you start to see the actual effects of what's happening now here. See? In the consumer prices and stuff. So this is just going to be another nail in the coffin for inflation to rise higher on items and them to charge more. Whenever there's snags in world trade or in world shipping. Let's get started into the other stuff here. Let's take a look now at the silver price. It's up 59 cents on the day so far. Which is a good little snap to the upside. I kind of figured they were overcooking it, overdoing it, knocking the price down too low, too quick. Whenever you see a market snap down like that so far, I mean, those are big drops we've had in the last week or so. So it's snapping back a little bit. It's at 23.73 today. Let's take a look at gold here. Gold's at 1773. It's up $19.50. Gold's move upwards still continuing right now. Uh, Now let's take a look at the cryptocurrencies, and they're seeing upward momentum too. They were in the 1800s yesterday, and today they're 1942. So we're seeing a Bitcoin price of 46,324. So we're not seeing an awful lot of movement in Bitcoin itself. This means that because Bitcoin's still at 46, we're seeing a lot more movement into these alternative coins right now, meaning that the whole industry, the whole cryptocurrency industry right now is in the coming into the meat of another rally. And this rally might be bigger than the last one we saw, where we saw Bitcoin go up to 64,000. We're in a rally right now. We're in a well, actually, to be honest, with cryptocurrencies, going all the way back to 2009, it's been in one big rally, to tell you the truth. If you take a look at the long-term chart, it's never left the bull market, cryptocurrencies. What we've had is we've had bull markets and we've had bear markets within a greater bull, and a never-ending bull market. So for people that just want to just buy it and hold it for the long term, if they're thinking like 10 years, it's just been in a constant bull market, and they've seen an awful lot of success. People who have hodled, what's called hodled, the cryptocurrencies. Let's take a look now at Dow Jones Industrial Average, 35,529 today. It's up 30 points. And now we're going to take a look at crude oil, 68.96. We got to keep our eyes on China right now. China is trying to do what they did with the original virus to contain it. They want to contain this new Delta variant. And so this might be the start of something big, because China's always stayed open, even through the entire first part of the COVID crisis. If China starts to put the close sign on their door, well, that could affect consumer prices terribly. I mean, we could see inflation. That could really help to feed inflation, on all your consumer products. Massive amounts of good comes from China, and often almost everything you buy now in the store comes from China, And if we see shortages on these products, well, of course they're going to jack the price up higher. That's just a no-brainer, And of course, when we're talking about food items now, we're talking about difficulties as well. We have not had great growing seasons around the world because the climate is off. It's like gone hooey. It's gone strange, the climate. Some places are colder than normal. Some places are hotter than normal. We're seeing it here. I've never seen such a hot summer as we're having here right now. Everything's gone kind of haywire with the climate. And so how can farmers really plan their crops and things if they got a climate that's acting so weird? It makes it difficult for farmers. And so that in turn extends out to the crops, And an awful lot of our foods come from growing, and of course we have produced meat as well, and maybe that's not quite as critical, but if they get a drastic flood or something, that can affect meat production as well. Okay, let's move on today, and we're going to take a look at the MOVE Index, and the MOVE Index is falling today. It's fell 5% today, down to 57.39. Bonds and rates, and what we're seeing is rising yields on the bonds today. I mean falling yields. Excuse me, not rising, falling yields on the bonds, especially on the long end of the yield curve. We're looking at 1.31 on the US 10-year, and we're looking at 1.96 on the US 30-year. So it's fell back down below 2% on the 30-year. And now we're going to take a look at the US dollar index. And we got a sharply falling dollar today at 92.56. There is a possibility, guys, that we won't have any deflation at all. If they can hold the markets and everything steady, hold the line, then we'll go right into the hyperinflation, but it'll take longer for the hyperinflation to get here if it comes that way, you know. If they don't do anything, if they just allow the markets to continue to rise and everything, and they keep pumping the money out there, and they keep a steady flow of money, and they don't allow liquidity to dry up, you know. What do I think the chance of that happening is? Probably somewhere around 35% chance of it happening, where they're able to stem off the deflation completely, and they're able to just keep us slowly moving toward a hyperinflation. But like I say, it'll take longer if it goes that way. It'll take longer for the hyperinflation to get here, because there's no sudden jerks in the system, deflation jerking us one way and inflation jerking us the other way. Now, the most likely scenario, though, is where there's going to be some sort of a deflationary crash. And then they're going to have to rescue us from the deflationary crash, which is going to boost us into the hyperinflation faster on the other side. That's more likely to happen that way, you know. But this is a very fluid and very dynamic situation that we have right now with the world's financial system. And because of that, it's a little bit hard to predict. Looking out into the future, there's so many different options that could happen, because we're in a crushing situation right now, you know. There's at least 3 options that I can see. One option would be that we have a deflationary event between now and Christmas. That would be the fastest option to move us into hyperinflation, the quickest. Because they would have to come in and repair it. And they couldn't let the markets, the further they let the markets fall, and the more deflation we have, the quicker the hyperinflation will come, because it'll take more and more liquidity into the system to repair it. So, if we're looking out not very long from now, within the next few months, and we have a major crash, it would take major amounts of money to get us out of that. And that would put us into the hyperinflation very, very quickly into next year. In fact, even by the end of this year, we could be moving toward hyperinflation in that scenario. Then the next scenario is that the the deflation holds off right through Christmas into next year, and we continue to see the markets go up right all the way until Christmas and into next year. Maybe sometime in around March we have a crash. There would be a similar situation, but you see that the crash would delay maybe 6 months further out. That would mean that the same thing would happen, but it would be 6 months further into the future, if it works out that way. And then the third scenario I can see is a scenario where we don't have a crash at all. We just slowly march toward inflation. Well, in that case, we're not going to see the major inflation come until toward the end of 2022, before we start to really get into the heavy inflation that starts to trigger the hyperinflation. And the hyperinflation probably wouldn't come until 2023, the actual hyperinflation, or maybe even 2024. That's the longest drawn out scenario. That's the scenario that takes the longest for us to get to the hyperinflation. Now, any one of those three scenarios could happen, you know, because we're at the end of a very long Ponzi scheme. You know, I was thinking about this last night, and we'll tell you guys. I was thinking about this last night. And the way the Fed originally put this thing together, yes, it was a Ponzi scheme, but it was a Ponzi scheme that could have dragged out for an awfully long time because the currency was connected to gold. And that's the way they originally designed it. It's like a guy, if he designed a car engine, you know, and he said, you got to change the oil every 5,000 miles. That's part of the design of this car engine. Well, that's like us being connected to the gold. You got to connect your currency to gold. It's like changing the oil. It's like that's what keeps it going for a long time. The guy says, well, what happens if I don't change my oil? He says, well, you'll drive for a while until your car engine will bust. It'll ruin it. And the thing will freeze and everything won't work. Well, what if we come off of the gold standard? And what if we don't use gold anymore and we print all the fiat currency we want? Well, that's like not changing your oil. Things going to break. Things going to seize up. Because it wasn't originally designed to run that way. So in 1971, Nixon took us off the gold standard. It's like they stopped changing the oil. And now the thing's ready to freeze up. They said, Nixon said, this is temporary. Temporary. In other words, 3 months, 6 months. It became permanent. It's like the guy, he says, well, I'm not going to change my oil, honey, right now. Right now, Martha, I'm not going to change my oil. But I'll change it. I'm just temporary. For a few days, I won't change it. But then he lies, and then he continues to drive the thing and not change the oil. That was what they did when they come off of the gold standard in 1971. They changed the entire monetary system from the way it was originally intended to be run. So it's really not exactly the fault of the Fed back in 1914 because they set us up on a gold standard. It's the fault of Nixon in 1971 by taking us off of the gold standard and ruining the entire world's financial system in doing so. They said, oh, we're going to stop the speculators. And this is only temporary. They knew it should be temporary. Because they were removing the peg, keeping the financial system on stable ground. Now we're in a mess. And now it can't go anywhere except a crisis. Unless they were to go back to a gold standard again. But they can't because that would be too painful. They can't even allow the system to crash. And so we're going to pay for all of those things in something that's very painful by either deflation or by inflation. One of the two. And the deflation would be more painful than the inflation. And so we got to see this thing through to the end where they're going to have to, in the end, go back to some sort of a gold standard. They're going to be forced to go back to something that stands behind the money to give it value. If they just create some central bank digital currency and make it just like the fiat that they're running with now, it's going to lose value just as fast. They're forced to go back to having something that stands behind the money that is hard money and gives money value again. And it doesn't necessarily have to be gold. It could be Bitcoin. Bitcoin has all the features of gold except it's electronic. Or it could be gold. I just don't know what they're going to do, but they're in a pickle. They're not going to get out of this pickle. They might have to go back kicking and screaming, but they're going to go back. Thank you guys for listening. Like and subscribe, and we'll catch you guys in the next show. Bye-bye.